The accounting equation. So what is the accounting equation? If you're a GAAP accountant and you learned your accounting in the 20th century and you grew up in the United States, then the accounting equation is owner's equity equals assets minus liabilities. If you learned your accounting in the 21st century and you grew up in the UK, then you're an IFRS accountant, and then the accounting equation is assets equals owner's equity plus liabilities. Three things that are certain in the future: death, taxes, and that we're all going to be IFRS accountants. GAAP or IFRS were united in one thing. Accounting equation will always remain in balance if double entering accounting is followed. I guess you've got to get your head around all of this jargon, so here's a big one. In the income statement, we talk about income and expense accounts being nominal accounts. That means that they're temporarily. At the end of the year, we add them up and we transfer the balance over to retained earnings or into profit or owner's equity. In the balance sheet, we have assets equals capital plus liabilities. When we combine the income statement and the balance sheet, we talk about the expanded accounting equation. That is, well, assets plus expenses equals income plus capital plus liabilities. Let's look at that in more detail than the income statement. We've got two main types of accounts. Income accounts, which can be income, which is the revenue generated from the sale of goods and services, and then other income, which is revenue from ventures and activities outside our normal trading. Expenses are those generally incurred in the normal business activities. And then these two are combined into a net profit or a loss, and that is moved to the retained income in the balance sheet. In the balance sheet, our assets are either fixed assets like land and buildings, plant, machinery, motor vehicles. These are things that get depreciated. Or they're current assets like bank, petty cash, the debtors ledgers, or stock holding, current trading things. And on the other side, we have our capital account, which is either capital, which is money that the owner put in, or the owner's retained earnings up to date, or shares issued if you're in a big company, or it's a member's contribution to the share capital. And then the liabilities are either long-term. These are big loans that we borrow and obligations that we have that generally last over a year. And we have current liabilities, in which are amounts owed by the business to like taxes or creditors, accounts payable, and little provisions that have to be sorted out in the short term. We put all of these accounts together in a chart of accounts. And the good news is that TurboCASH has ready set books or charts of accounts ready for you to use. And preferably you should pick the one where it's best for the country that you live in. When we put all of these accounts together in a chart of accounts, we get something like this. And here's an example. And this is a British system from the 20th century. And you can blame me for much of this. In those days, in the 80s, we only had 3-digit account code spaces. So you can see our account codes here with 3 digits. And the income and expense accounts come like this. Income up first, cost of sales against that, and then the expense accounts, and finishing up and not showing up here, the income tax reported on the income statement, which is the income tax which pertains to the revenues and expenses that are in this income statement. And what then has to be paid over to the receiver in the near future is reported as a current liability on the balance sheet. On the balance sheet, we start with share capital, and we have our retained income which comes over from the income statement. And our liabilities are long-term liabilities, such as loans or installment sale, and then we start on assets. First, fixed assets, which are put in at book value, being the purchase price less the depreciation and giving us the book value. And then we have the debtors as our current assets, along with our deposits paid, balances in our tills, cash, and then our control accounts as the liabilities. Then the current liabilities come at the back end of the set of books. And that's things like our creditors control account, our salaries control account, the taxes we owe on salaries, and then my favorite, the VAT control account, which has got our output minus our input, and our VAT payment account, so that these must all balance out, and then a suspense account, and lastly, the suspense account where we dump transactions that we're uncomfortable with, not to be used without trepidation.